Take a look at how commodities are doing in early Asian trade. This day we've got NYMEX crude the front month down slightly, about 1/4 of 1%, 97.15. Brent is at 117.32. Silver 40.36, and gold at 1614.94. Looking a little bit better. Gave up some ground overnight after hitting yet another record high near 1630 there. Let's get to Jay Taylor, President and CEO of Taylor Hard Money Advisors. He joins us live out of New York. Jay, you're a gold man. That's what we always talk to you about. Talk to us about, a couple of minutes ago we were talking to an earlier guest about what Nomura called a breakdown in cross-asset relationships, or rather in, I guess, cross-asset correlations. What's going on with gold and currencies, especially gold dollar and also gold euro? What do you see happening there?
Well, I think over time there's been an erosion of confidence in fiat money. Oh, you know, it used to be the dollar and gold were negatively correlated, and now what we're seeing is we're seeing a negative correlation as the currencies over time. We're seeing gold rise no matter what the currencies are doing to each other. So, you know, give or take, you can see the euro rise against the dollar and against gold and vice versa. But generally speaking, I think we are in a secular bull market for gold. And that is typified by gold rising against all currencies, against all fiat money. And certainly what's been going on in Washington has not given any confidence to fiat money, I should say.
Okay, 1615 is where we're sitting. It's, I don't know, at some stage it gets almost pointless, but we're sort of obliged to do it. Do you have a target for gold this year?
Oh, you know, I think 1,800, 2,000 even. I mean, who knows? The problem is it's all a confidence game, isn't it? And if it just depends. I mean, if the global economy continues to muddle along and we see positive growth and nothing cataclysmic happens, then I think, you know, we keep seeing gold trend higher. We keep seeing, you know, probably strong oil prices and commodity prices. But if we get another problem like a Lehman Brothers problem or a credit contraction, and I think there's no doubt longer term that's likely to happen, we have what I think is a major deleveraging in the global monetary system. Debts have grown to the point where they cannot be paid in one way or another, either through debt deflation or through inflation. Those things are going to be taken off the books, and until we see debt reach levels that is manageable again, then I think we're going to continue to see gold in a bull market. And if we should have a mistake, a deflationary event like Lehman Brothers again, then we look for the real price of gold. What does an ounce of gold buy? And gold rose very dramatically against almost everything else. I measured against the Rogers Raw Material Fund. After Lehman Brothers, what an ounce of gold will buy rose dramatically. Hence, mining company profits, gold mining profits, have surged since Lehman Brothers.
Jay, if we get some sort of resolution, and we all hope there is one, in terms of Washington raising that debt ceiling, and we do see sort of gold peeling back some of these gains, would you advocate investors getting into the precious metal itself, or some of the ETFs, or maybe through some of the gold producers out there? Because there seems to be a distortion between equity prices and the price of the hard metals still.
Yeah, absolutely, and I think that's partly because we have ETFs these days. People don't understand gold mining. It's riskier to buy a gold mining share than it is to just buy the metal. But on the other hand, as I just noted, the real price of gold has risen dramatically. Major mining companies' profits are rising very dramatically. However, I might say that I'm much more bullish on the juniors, or the new producing gold mining companies, and not necessarily the top ones, because those guys are having a hard time replacing the gold that they produce every year. And so they're having to go down the food chain and look for the smaller companies, the new producers and the juniors that are finding lots of gold in the ground. That's where I think the real money is going to be made, because the senior mining companies have to pay through the nose. They have to pay $500, $600, $700, $800 sometimes for an ounce of gold in the ground until they take their cost. There's not much left. The cost of getting it out, there's not much left. So I think that the mining shares, I think longer term, are going to do better than the metal itself. And okay, I could see a peeling back of the gold price. I could see it happen if there's a resolution. But long term, there's no resolution. They're continuing to print more money to pay the deficit. So if we raise the debt ceiling, it means more debt, more fiat money, more money created out of nothing, and that's bullish for gold and silver.
All right, Jay, everything you're saying makes sense to me. Why go into the miners rather than into the metal itself? But you know, John Paulson, his biggest position is in SPDR ETFs. No.
Well, you know, I think that's the easy way to play the game, and I think from a trading perspective, ETFs, you know, I buy some GLD for myself. I think I'm actually looking at GLD as sort of my, it might be risky, but I'm looking at it as sort of my cash source, and I'm in and out of GLD and then buying shares when I think they're undervalued. Of course, that's risky relative to the currency, and if we get a resolution in Washington, you could see gold pull back. But, you know, we've had 10 years of higher gold prices, each of the last 10 years, and that's, you know, sooner or later it's going to come to an end. But again, I don't think it's coming to an end until this global excessive debt situation is worked out. And I honestly don't see any resolution to that. If the Republicans won in Washington, if they had their way, if they forced a heck of a deflation and a depression in the U.S., I think that would actually be good. It would be terribly painful in the short run, but it would really clear the debts. It would really clear the debts off the books, and we could get on to some real rapid growth. Of course, that's not going to happen because no politician wants to be blamed for that kind of pain. But in my view, that's what should happen. And it would be better for us longer term.
Yeah, a purge or a catharsis, although, yeah, I don't think any politician would even survive that. Jay, good to talk to you. No. Thank you for the time. Jay Taylor, President and CEO of Taylor Hard Money Advisors, live out of New York.